Hello everyone, this is Jordan. Welcome back to the Daily Gold YouTube channel. Thank you so much for joining me. This video is being recorded on the evening of Wednesday, February 26, 2025, coming up on the end of February this week. Again, thank you so much for joining me. In this video, I am going to talk about the three structural issues that have kept gold stocks from performing well and outperforming gold. Now, I did a video a couple days ago in Macro Mondays talking about why I think gold stocks are in a real sweet spot or about to move into a sweet spot. And so this analysis is not contradicting that. I am in this video just pointing out the three structural issues that have impacted the mining sector since the peak in 2011. And by the way, one of the three issues may be permanent. One of the three issues is now gone, and there's one issue that maybe sometime this year we will see that issue gone. So over the months ahead, we could come into a situation where two of the three issues plaguing miners are gone. And these are big-time structural issues. These are not smaller things like bad management or ESG policy or stuff like that. We're looking at the big structural issues. Now, enough of me babbling. Let's get to the charts and to the issues. So one of the issues, and I would say this is number 2 on the list if we're ranking what are the three most important. And this is the one issue that is no longer. And that issue was the secular bear market in precious metals from the 2011 peak to the end of 2023. I mean, you can measure this. Is it here in March of 24 to the end of the gold breakout? Some people might say it's here in the middle of 2022 or October 2022. With respect to silver, putting it here when gold began that breakout move, I think that works out better. So that's why I've put the line here and then these lines here. First one is the silver peak. Second one is the gold peak. So we had a secular bear market, people. I mean, what do you expect? Valuations are going to go down, and I'm getting to that in another slide. But in a secular bear market, again, valuations are going to go down. So the mining stocks are not, they're a leverage play, and that's because of the number one reason. But they're a leverage play on gold and silver. And so in a bear market, a secular bear market, they're not going to perform well. So this is a reason, and again, rarely anyone has mentioned this. And so we can see here, we have the Huey index against gold, so the Huey gold ratio. This is GDXJ against gold. Now, you can go back on the parent company of GDXJ, that's MVIS, Market Vector. So there's a website. You can get data back to 2004. Now, in 2003, I attached my own data to this index. Now, in 2003, you may remember miners or junior miners just absolutely crushed it. But even with that being said, GDXJ against gold, that peaked in 2007. Now, the Huey against gold, you could say it peaked here 2004, early 2004, maybe almost a double peak here, 2006. So it really didn't fall off until towards the end of 2007. So we can see here what happened after the 2011 peak, getting back to that. Huey against gold, GDXJ against gold. But why did the miners, why did they peak in the mid-2000s against gold? GDXJ and the juniors, they peaked in 2007. There's something that happened in late 2004. And so this is the number one reason. That was the introduction of the GLD ETF. So the introduction of GLD and other ETFs financialized gold. Before 2004, how would you buy gold or silver directly? You would have had to go to a coin shop. You would have had to go to a futures broker. So for fund managers who just want to buy stocks and mutual funds, they had no access to buying gold or silver. So how did they access that? Through buying the mining stocks. So the introduction of all these metal ETFs, that added a huge amount of competition for miners and juniors. So these stocks did not have that competition pre-2005. So that, to me, is the number one reason. And whether that's permanent or not, because some people will say, well, these ETFs, they don't really have the gold or silver. So we'll get into that. Maybe, at some point when people really demand physical, it'll be proven that they really don't have the gold. I mean, in that case, that would be super bullish for the mining stocks. But that's another issue. But so all that aside, the number one reason is the introduction of the ETFs, and that is a permanent reason for now. So that has diluted the buying power in the sector away from buying miners. And the number two reason, which I said first, is the secular bear market. And so before we get to the number three reason, I want to talk about the impact of the introduction of those metal ETFs on valuations in the sector. So this is one valuation chart. So this is price to NAV, price to net asset value for the gold stocks. This is the secular bear market, basically here, because this chart is, probably right about up until the time gold broke out. So this is a secular bear market here. Now, this was a secular bear market too in the 80s and 90s, but look how much higher this valuation was. Now, I do expect, ultimately at some point in the next few years, we'll probably see this climb back above 1.5. So there's a lot of room for this valuation to move up. But the more important point is you had a secular bear market in gold in the 80s and 90s, and just look at where the valuation was. This is a secular bear market. So why is the valuation so much higher? Because fund managers, institutions, retail investors, to get exposure to gold, and less so silver, they had to buy the mining stocks. So they traded at a higher valuation. Now, the same thing is true with price to cash flow, although it's not as stark as in the last chart. But this chart, this is until, is this 3 years old now? Well, that's a little old. But basically, if you look at the last 2 or 3 years, the valuation on gold stocks, price to cash flow, I came up with late last year, I mentioned in my book, they're at about 8 times cash flow. There was some data, I think it was a bonus chart I put in. I could have put that in here on another slide, but I didn't want to be redundant. That showed, I think they've kind of ranged from 7 to 9x. So basically, this is fair. Since the secular bear market, this has 9.6x cash flow, but for me, it's probably closer to 9. Now, let's look at the 1990s here. This was in 2000, when this was an epic low in precious metals for everything. But look at the 1990s, secular bear market, but look at the price to cash flow valuation. The average is probably 12x, you could say. So it's just another example of the valuations being lower or being much higher before the introduction of those ETFs, those damn ETFs for mining stocks. And again, that may be permanent. Now, let's get to the last reason. And this is the one that's it's waiting in the wings to fall. And that is the secular bull market in the S&P 500. So we have gold here, stock market here. Here's gold against the S&P, gold against the 60/40 portfolio. And so we're a couple days away from the end of the month when this chart will update. But I updated it a day or two ago. So unless gold really falls apart, which I don't think it will, you are going to see a clear breakout move starting in gold against the 60/40. And gold against the S&P, look at where this is. This is almost at the breakout point. I think this is this is a weekly or monthly chart, by the way. So I've talked about this. The fact that you have an ongoing secular bull market in stocks has held back precious metals. How is it holding it back? Because it's restricting capital flows into precious metals. So the only capital that's going into the sector is these normies just buying GLD, and maybe they might buy a little GDX after it's already up 100%. That's how they work. But that's why so many juniors and exploration stocks and silver stocks, most of those are really low quality, so they need spec money to come into the sector, but they're underperforming and not performing because no spec money is coming in the sector. It's not spilling over because generalist money are just buying stocks. This is still in effect. And again, that's restricting capital flows into precious metals. So the only money that's in precious metals is really industry money. And yeah, there's a little bit here and there coming in, but you need an influx of more and more capital and generalist capital to come into the sector because eventually that spills over into the miners and the juniors. So at some point here, we will see this baby will hit a secular peak. And who knows? Maybe it's happening now. Maybe it'll happen in 3 months. Maybe it'll be 18 months, 7 months. I don't have a strong opinion about that yet. But When that happens, one of the three reasons is gone. Actually, two of the three reasons are gone, because you do have the metal ETFs taking away capital from the miners. That's kind of permanent. The second thing, secular bear market in precious metals, that's gone. That's over with. So this is the other thing that is close to ending that's hurting the mining stocks. But we are getting really close to a turning point, because this is breaking out. And then when we see this thing break out, that is going to lead. Yes, there will be corrections along the way. But again, you get a big breakout move here and here, you're going to see gold explode and go to 4,000. And the mining stocks and the juniors absolutely explode. And look, we talked about all this in our last video. So we're not changing our opinion on anything. We're just pointing out there's three structural reasons why the mining stocks have underperformed. One of them is gone, so there's only two of the three left. And maybe after this year, only one of the three will be left. So that's where we are. But look, this is a good thing for the mining stocks, because we showed you that ETF flows in the sector, the capital in the sector, it's still really tiny. There's room to move. And the stocks are up 100%. GDX and GDXJ since that October 22 bottom. I mean, the last 12 months, they're up, what, 50 or 60%, the ETFs? And people still absolutely hate them. So that's a really, really good thing. So this is a bit of a history lesson, because we've moved on from the secular bear market. Miners and juniors and exploration companies, they're still struggling. So this video is just a analysis of the three structural reasons. And again, pretty soon, two of those three reasons will be gone. And there will be much less resistance towards mining stocks, exploration companies, and juniors. But we're not quite there yet. So let me know what you think of the video. Do you agree? Do you disagree? Is there a structural reason that I missed? It's got to be structural. Leave a comment. Let me know what you think. Again, thank you so much for tuning in, and I hope you guys have a great rest of the week. I'll talk to you guys again on Friday for the weekly wrap-up.